Welcome to Fidelity Soundbites, a monthly podcast where investors can tap into Fidelity's more than 400 investment experts who are on the ground around the world so that you have the inside edge when it comes to making more informed investment decisions. From equities to fixed income to private assets, let us help you build a better financial future.
Hello, welcome to Soundbites, Fidelity's podcast where we talk about all things investments. My name is Lukasz de Pourbaix, and I'm very pleased to be joined by Salman Ahmed, our Global Head of Macro and SAA, based out of London, and he's just fresh from talking to a lot of clients around the globe, talking all things macro. So we're very pleased to have you on the podcast, Salman. Welcome.
Thank you, Lucas. Thank you for having me.
And it's quite timely, I guess, that we're having this discussion because there are big forces shaping markets at the moment, both geopolitical, economic, a range of factors. And one of the questions commonly asked by a lot of investors out there is, are we genuinely in a new global regime, or are we just sort of in a noisy period? Interested in your sort of initial thoughts before we sort of get into the meat of it.
Makes sense. No, I think our view is that we are generally going through profound changes in the world order, which is running parallelly to whatever the cyclical macro and markets are doing right now. But the relationship between the key economic and security blocks are being recalibrated. U.S. Engagement model with the rest of the world is changing, especially with Europe. And we have seen several episodes of that, which have intensified discussions and focus on that transatlantic alliance, if you will. So some profound changes, and our base case remains that over the next few years we are likely to see a more fragmented world rather than a rule-based order, which was in play since World War II.
Mm-hmm. And just on that, one of the terms that certainly has become much more prominent in the global debate is this: have we moved from or are we moving from a unipolar world, which was really sort of characterized post 1991, the fall of the Soviet Union, and we had a dominant power, in the US, and whether we're moving into a multipolar world. And just before we get into that, I mean, it is a term that's widely used, but when we talk about multipolar, what do we actually mean?
So this is basically a concept of multiple superpowers, if you will, working through their own spheres of interest, and in some cases overlapping interests. And then with the fall of Berlin Wall and the end of Cold War, we saw the challenge posed by Soviet Union to the transatlantic alliance melt away. But now we are in different environment where China over the last 25 to 30 years has risen as not only as an economic power, but also a military power. And with its own independent technology, which is leading to this or powering this multipolar concept, whereby the superpowers of yesterday and today, which is US, whilst an emerging superpower tries to find a new steady state relationship, which was not the case when China's rise was ongoing. So this is more about spheres of influence backed by military and economic powers.
And if you sort of think about that multipolar environment, what sort of practically may that mean for global coordination, impact on growth, impact on things like inflation?
So I think the most fundamental implication of that is the free flowing and free market based trade order. The neoliberal economic order is under stress. US under the current administration has used its economic muscle to put tariffs on the rest of the world, use tariffs or threats of tariffs, I should say, for geopolitical outcomes. And that is a trend now. It's not just episodic one-off. It's a trend of a change in the way US operates vis-a-vis the rest of the world. So in terms of globalization is no longer an unquestioned virtue anymore. You are seeing signs of state capitalism rising as a result. You're seeing signs of obviously frictions in trade. and more structurally focus on self-reliance is starting to take shape, especially in Europe. So it's still very early days of this new regime bedding in, but you're seeing tangible signs now appear, given that Trump administration has been in power for more than a year now.
And if you think about that sort of on that theme, and these sort of different sort of, I guess, blocks within the global economy, one of the topics that is also quite common is talk about the US dollar as obviously the reserve currency of the world. Is that under threat? We've seen some central banks buy up gold. You've seen different moves to sort of diversify away from the US dollar. How real is that threat to the US dollar as the reserve currency?
I think US, as you said, is the premier reserve currency, and reserve currency discussion has to be across multiple dimensions. US share in trade invoices remains high, although the share of CNY has been going up. The one dimension of the reserve currency which is under pressure is the allocation reserves. So US dollar share peaked a few years ago, and it has been on a steady declining trend even before these intensification of these forces we are talking about took place. So that's the one whereby you see central banks outside of the perceived US orbit diversifying their reserves, and it started in earnest after 2022, after the Russia's invasion, and it has now spread out to other countries as well. And that's the dimension which is the core one, which is under a bit of stress. But I don't see dollar not being a reserve currency, but its role may get diminished on the margin rather than completely collapse, if you will.
And you touched on Europe briefly in your comments, and there's been obviously a lot of action in Europe. We've seen Trump call for greater commitment to contributing to NATO. We've seen obviously moves on Greenland, which has probably caught many by surprise. And central to all of this has been defense and defense spending, and we have seen a lot of focus on this part of the equation. I mean, what's your view? Is this a structural shift in that defense dynamic in terms of how economies are sort of allocating to defense? What's your view on that shift?
So I think the overall world we are in is a low trust world, and technology and the role of technology is very different. In fact, it can technology is at a stage where the provider of that technology can leverage or has a lot of leverage. It's not like the olden days that you'd buy a tank and it is yours. Now you have an umbilical cord connected to the provider of that asset. Software, is as important as the hardware, if you will. And in a low trust world, that becomes a challenge because then the provider of that technology and hardware can always use that as a leverage. And I think that connects to in Europe specifically, the NATO umbrella and the question marks being raised around the viability of NATO, especially given the context of Greenland, as you mentioned, and not only Greenland. The Russia-Ukraine settlement seems to be moving in the direction of Russia's position. So the underlying trust in the U.S. Security umbrella for Europe is under stress, and that is one of the motivations behind self-reliance and strategic autonomy becoming a priority for many countries, especially in Europe. And of course, U.S. has been pressurizing Europe as well to increase its defense spending. So this is a longer-lasting theme, given that this low trust world is here to stay.
And if we sort of shift focus a little bit, and another big sort of topic concerning many people out there in the market and investors is the topic of interest rates. Now, we have obviously seen inflation move down from its peak a little while ago, but it does remain sticky. And if we look at markets like the US, for example, the market has been anticipating further rate cuts, which haven't come through. And then in the case of Australia, we've actually seen a rate hike. What's your view on where we are on inflation? are we heading towards a lower rate environment, or is the new sort of neutral rate higher than we maybe have thought?
So I think let's start with the Fed. We have got Kevin Walsh's appointment now. Initially, the market, I think, reaction was that he potentially will be hawkish, which I don't believe that he would be. We have seen people change their minds in the current administration. So we think this is going to be a friendly Fed, which will tolerate higher inflation. And in our CMAs over the last few years, I think we discussed that in our previous episodes as well. That in our CMAs or capital market assumptions, our assumption for US inflation for the next 10 years remains at 3%. So we think there is more appetite for higher inflation and overall nominal growth being supported through the fiscal side, but also pressure on the monetary side to take some burden sharing, if you will. So we are expecting 3 cuts this year, especially going into the elections. This is a very important political year for the US. Midterms are important, and we think that potential for a fiscal stimulus and additional cuts going into the midterm remain high, given the political cycle we are in. In terms of the spillovers for the rest of the world, I think we can, I guess, talk about the other central banks, but that's the core view for when it comes to the Fed.
And did you pay attention at all to Australia? We had I think it was a week or so ago, we did have a rate hike just recently. We had a cut previously, and but inflation has remained sticky. Is that a maybe a symptom of things to come across other economies?
So I think for major economic blocks, probably less so. So, for example, in our view, ECB next move is likely to be a cut rather than a hike.
Yeah.
Euro is appreciating, and that is obviously going to create some downward forces on external or imported inflation. You have China dumping in Europe going on as well, which is another source of disinflation. So I think for the major economic blocks, the Fed being dovish and cutting rates also puts pressure on them to cut rates because of the FX angle. Whilst I think beyond the major blocks, I think obviously domestic cyclical and external demand also matters. So, minerals are in demand. Australia is going through a positive terms of trade shock. But that is not the case, for example, for UK or Europe.
Yeah. And if we sort of focus in on Asia, China's certainly been a point of debate and topic for a lot of investors over the last couple of years. What's our current view on China in terms of the future economic growth? Obviously, we've had these movement to this multipolar world, trade negotiations, tariffs, and so forth. What's your view on the road ahead for China?
So China, I think, remains in a controlled stabilization mode. So fiscal policy support is there, not in a very significant or big way. They're not reflating the domestic economy. There's a dual economic picture right now. The external sector is still doing quite well. So even though exports to the US have come down, overall exports are holding. There's been retransfer of exports to Europe and other regions of the world, especially in LATAM as well. But that model in itself is it's not a very sustainable model. Ultimately, China will need domestic demand and strong consumption growth, but the property sector overhang is still passing through the system. So cyclically, it's more about control stabilization. I think the focus more is on geopolitics and geoeconomics. And we have the visit from President Trump coming through in April. But as so far, I think the cyclical macro remains steady, but it's not out of the woods, if you will.
And so if you think about that dynamic between, you've got the US, you've got China, arguably we're in a multipolar world where, the big sort of powers look to sort of, dominate in different ways, one over the other. What does it mean for middle powers? So, the likes of Australia, for example, for these, smaller countries sort of in the middle, usually sort of stuck between both in a way, between the, having to trade with China, having a relationship with the US, for example. How do they navigate, in your mind, this sort of fragmented world that we're sort of heading into?
I think, as you said, I think it's going to be it's a much tougher environment when there was globalization, free flow of trades and trade and capital. This is fragmentation across multiple dimensions bedding in, so not only economic but also people movement. You saw that in the US, and then ultimately capital flows will also start getting affected, and we are seeing some signs of that in Europe now with home bias becoming a much bigger theme, if you will. So I think for middle powers like Australia, I think it depends on this is a more classic world where the countries will have to think what are they bringing to the table in terms of the rivalry, how are they managing that rivalry. Like for example, in Australia's case, China is the biggest trading partner, uh, uh, and uh, and then if you think about it, but at the same time, you have the security umbrella, which is US centric. So I think that tension will remain, but it's the question of how the governments navigate that, and it's a tightrope, and ultimately it goes between the relationship between US and China at its core, right? How Because that's the fundamental rivalry at its core, rather than everything else then fits into the block, if you will.
And so maybe if we sort of head to the sort of the final parts of the podcast, a couple of interesting ones. So first one on, I guess, for investors out there trying to navigate a lot of moving parts, arguably big shift in the regime from unipolar to multipolar. From a portfolio perspective, how should investors be navigating this type of environment?
I think our view for some times, as you know, Lucas, has been that investors should look at diversification across multiple dimensions. Portfolio, global portfolios tend to be more US dominated right now. 60% of equities is US share in ACWI, for example. In fixed income, the US dollar instrument share is 50%. And within US equities itself, you have a lot of concentration risk. So we have been focused on bringing diversification, for example, across styles, regions, sectors. Then FX becoming a major and core risk lever, especially for Europe, for example, Euro-based investors. Overall, as I mentioned, we think that we are in a multi-year downward cycle in the dollar. S&P returns in euro terms last year were not that good. It was almost barely positive in Swissy terms. So FX will be a major differentiator between performances experienced by different investors. So we think FX hedging should be a core risk lever. Then you need explicit downside protection in your portfolios. Bonds are likely to be less of an effective stabilizer because inflation is likely to be averaging higher. We expect positive bond equity correlation to remain in place as this new world comes into play. So you need additional bond-like features in your portfolio, whether it's through downside protection, dynamic duration management, or right kind of alternative liquids. And lastly, private assets also have a role to play. Manager selection is always important in private assets, but we like infrastructure and real estate, for example, in Europe, which can benefit from the low rates and the further cuts we expect. So it's about spreading your bets because the current configuration of portfolios are very much US dominated in terms of both their risk profiles and also their currency profile.
Yeah, no, it's a valid comment. And if we sort of one final question and thinking about a bit of a sort of crystal gazing is looking at the year ahead. It already feels like we're already well into the year. It's only February, but if we look at for the rest of the year, what are the sort of the top three things you'd be suggesting investors think about for the next the remainder of the year?
So I think in addition to the diversification angle, which is a multi-level angle, and certainly we can help our clients with that. But in terms of the major themes, as I mentioned, I think dollar depreciation and and the associated performance of gold. We didn't mention gold, but we do think that gold has a very important role to play in strategic asset allocation as a mirror image of this dollar depreciation going on. That's, I think, obviously the volatility has been much higher. Leverage and retail engagement has created bouts of these very severe volatility, but the trend to our minds remains towards further appreciation of gold specifically. So it's, so that's one theme. Another theme is playing the wider beneficiaries of AI rather than the core names. We already see software come under pressure because it's seen as AI is seen as completely replacing software. Although the story is more nuanced. I was listening to our analysts. There are some winners out there as well in software space who can integrate this AI, and they're already the backbone of major service delivery. So it's being nuanced. Sector dispersion is likely to be higher. We think that alpha generation opportunities should widen, but there's a lot of shocks going on. What we don't think is that this is not a recession year. The probability of recession is pretty low. Nominal growth is likely to remain high due to political support. Even if there's a big enough bubble in AI, we think that the US government will come in and support that through direct interventions. So this is a year of strong nominal growth, but other underlying trends, as we discussed earlier, taking hold. And then last one is home bias and national champions. This is a theme we have to watch, especially in Europe, because Europe is under pressure politically to go towards strategic autonomy, and that's something which we are watching also very carefully.
Excellent. Well, Salman, thank you very much for taking the time. I know it's very early there in London, so appreciate it, and talk to you again soon.
Cheers. Thank you very much, Lukasz.
If you've enjoyed today's episode, make sure to subscribe to Soundbites on your favourite podcasting platform. Otherwise, if you'd like more information on Fidelity or Fidelity products, please head to our website at fidelity.com.au. Now for some important information. This podcast is issued by Fill Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation, or needs. You should consider the product disclosure statement and target market determinations for Fidelity Australia products at fidelity.com.au. Please click the link in the show's description to read the full disclaimer.